Welcome back. So I saw something just a minute ago when I was stopping the recording and starting it again, and it made me think that it's handling this properly and that you're going to wind up being able to see two recordings from two different sections of the night. If I find it's a real long video, we might do something about it next time, but it looks like it's okay. So as I queue up, and I'm going to do that right now so that you can see the screen and chapter 2. Let me just kind of say anecdotally that sometimes they talk about professors being sages on the stage, and it's kind of a negative thing that talks about how professors might want to just get up there and talk for a while. So I found people less and less interested in long conversations about the material. Like, people like seeing and asking about what they know they have trouble with, but they just don't necessarily want a guy up there talking for an hour or more about a subject. So this is a 69 slide slideshow. There are probably some toward the end of it that are like appendix type stuff, but this is normally this hour a night is usually about all I'm going to talk about new stuff. Because as you saw, we had the hour conversation about the slideshow on chapter 1 last week, and then we had an hour on the homework. And it seems like that's a better use of a few hours than just, going through this in detail. So what you're going to find is I move through some things, try to talk about the most important things, and we get through it and we're done. I think we'll probably be wrapping up about 5 minutes before the class would normally end, normally about like 6:35. So this section is called the accounting cycle during the period. I don't know what I think about textbook authors making a big deal about the accounting cycle. There's some things to do in accounting, and I don't disagree with that, and I teach it, but the idea that, we're focused on it like it's a cycle, I don't know. But anyway, the next two chapters are put in the perspective of some things that are necessary to do during the cycle or during the period, and some things that are necessary to do at the end of it. So to that extent, although I don't know about worrying that this is a cycle, it is important to think about the things you do during the month, during the year, and the things you have to do at month end or year end. And so in chapter 2, we're talking about all the things you do during the month or during the year. This is kind of a reminder from last class that the functions are measure business activities of the company. And notice we're going to talk about recording transactions. In a foundations class, you don't normally have to dwell on recording the way intermediate accounting might do it for new accounting students, but you do have to know a little bit about it. It is important to me, and I think it's important in any class, that you know how to make accounts go up and down. And then also, it's really important, we talked last time about how financial accounting is done by professionals, but they're insiders for outsiders. And therefore, no matter how good the outsider is, they can be fooled. So it's important to have good, accurate communication about what's going on in the company. And the financial statements are the primary way to show good accounting information. So we're going to think now about measuring the business activities. Nothing new on this slide. We're going to talk a little bit about source documents. One frustration I have, I admit I haven't dwelled on the Spiceland book so much, you know, it might not surprise you that much that I've taught basic accounting classes 100 times probably, and I haven't read 100 books. You know, I mean, I don't necessarily read every book we ever talk about. But the thing that frustrates me sometimes with the way accounting books are written is they tend to still spend a lot of time wanting to talk to you about paper. And I tell you, if you started to practice accounting like I did in the 90s, you believed that paper was important. Back then, we used to believe that the only permanent thing you had was a paper. And so we really wanted to hang on to it. And let me tell you someplace in my life where this changed in a big way. I guess cloud computing, because it's probably not all chronological here. I guess cloud computing really became super good. 2005, 2010, something like that. And when I really realized how good it was, I remembered a story from my past, from my youth, that, and really way before my youth, that that pointed out why paper isn't always what it's cracked up to be. So my grandmother, God rest her soul, is no longer with me, but you know, middle 20th century, maybe earlier, she was born in a small town in Pennsylvania. And not long after she was born, the county courthouse burned down. And so all the records of the people that were born there and, you know, real estate records and everything like that were lost. So that didn't seem like any big deal, you know. They made some contact with her and told her what kind of stuff happened, and it didn't seem like a big deal until she decided she wanted to go on an international trip and learned that officially she had never been born. And so to be able to prove that she had been born, I guess it's the same in most every state. If your courthouse burned down, you needed to write to the governor or the governor's office. I'm sure he or she doesn't answer all those things personally. And you had to explain that, you know, your courthouse burned down, but here's all the other ways they could tell that you were alive. So then the governor, you know, I think in the end, the office sent something and she had to get it notarized by notary public. But I guess the point to all this is today that wouldn't happen, because today any remote county courthouse would upload their records to cloud computers. And if the small courthouse in Western Pennsylvania was burned down, you know, the cloud computer in Tokyo, that was one of 30 computers that had it, would be working just fine, and it would retrieve the record. So I understand all this to say, I understand why accountants like paper. I liked it once too, but really the more I understand cloud computing, the more having old papers around are not all the things they're cracked up to be. Because yeah, as long as you have the paper, that's good. But if something beyond your control happens to the paper, oh my God. Here's another kind of freaky story about that time. Not a personal thing, just something I always learned about. There was a time when some stocks were bearer stocks. And what this meant is if you bought stock in a company, you got this piece of paper in the mail that said, or wherever, that said you owned the stock. And if somebody stole that from you or you dropped it on the ground, all of a sudden you didn't have the stock anymore. Relates to, I don't know if, and I'll get off the soapbox, but it relates to, if any of you like the holiday movie, It's a Wonderful Life. I like it, and I've seen it most years, but this year, for whatever reason, I didn't. But in that movie, a big turning point in the movie is the good guys have a family business that's a bank, and they're, you know, like muscling it up and what's the expression I want to use? Like they're puffing it up, joking around with the bad guy. And the next thing you know, The good guy who's carrying the big bank deposit drops it on the ground. And the bad guy figures that out and takes it and puts it in his private stash. And all of a sudden, because that was cash, the bad guy has all the money. And then they spend the rest of the movie, sorting that out. But this kind of stuff doesn't happen with good modern computing. And so sometimes I think the paper stuff's a little long-winded. We're going to analyze the impacts of transactions on the accounting equation. That's very important. Also, we're going to introduce the terms debit and credit. And I don't know what your book says about these yet, but I know when I was an accounting student, these were long definitions because an accounting textbook author couldn't stand to be wrong 1/1,000,000th of a time. So how do you make sure that not even 1/1,000,000th of a time are you wrong? Well, you have to say every single thing and every single condition that might alter a definition. But let me tell you, I'm not worried. What I'm telling you now will get you through accounting class very well, which is all I'm trying to do. And I don't care if you can prove me wrong in 1/1,000,000th of a case. Debit means left, and it doesn't mean anything more than that. When we use debit, we're thinking about putting it in journals. Honestly, sometimes this lecture in accounting class, I tell people, you got a homework assignment. When you walk around or drive around after class, don't take lefts and rights, just take debits and credits, and you'll kind of remember. I'm not doing that here, but keep it in mind, debit really doesn't have any bigger meaning than left, and credit doesn't have any bigger meaning than right. I can't spit that out without saying this next thing that also shows up in one of the podcasts that you guys have access to. It might be the chapter 2 one. You can never say that debits or credits are better. So don't even try. Sometimes I find it's a very American, very normal thing to try to boil something down as simple as you can get it. Nothing wrong with that. That's perfect. But sometimes you need to recognize that things can only get so simple that you can't boil it down any more simple than that. That's the way they are. And you can't boil it down to anything more than sometimes debits are good, sometimes debits are bad. Sometimes credits are good, sometimes credits are bad. Here's the classic case. In one of the transactions we saw a little earlier, in the homework, we didn't think about debits and credits there. We thought about the one business paying the other business for work. Imagine that you're doing accounting for the business that did the work. So you go to record a transaction. I'm going to tell you why you do this later on. So don't worry about why right now. But you debit cash because you got cash in, and that's the way you show cash going up. And you credit revenue because your company made money. Which one of those is better? Now, this is a rhetorical question. It's not a thing I'm going to ask you to answer or anything. Neither of them is better. They're the same. It's like we said about accounting in general. The accounting equation works because we're talking about the same identical stuff. So it just doesn't boil down any faster than that. So don't try it. Don't come up with your own little anecdotes of thinking about debits or credits being better. Don't ask me if it's okay in these cases. Simple answer is you don't know. You have to look at what makes accounts go up and down to tell if it's good or not. The book that we're going to use, that's another place where accountants can go off the deep end to me with paper, is the 1960s. They had these big books full of paper. Walmart was a very small company then. I could give you the long story on this, but I won't. If they were as big then as they are now, and Kmart, we talked about them a little last week. Kmart was big in the 1960s like Walmart is now. I mean, they might have had a whole wall of an office piled up with volumes of a book that, when you added all those volumes together, were the ledger. I'm sorry, were the journal. The ledger would be another one, but we're talking about the journal now. And really, this is just the book or the spreadsheet or something that you put all these debits and credits on. The general ledger is another book. If the general journal just has all these transactions listed, both the debit and the credit, some people compare it to a diary. Here's how it compares to a diary if you care about such things. A diary just has chronological entries. Person writes in it every day what they're thinking. Like that, the general journal just has transactions written on the day they happened. The general ledger is a book of spreadsheets. So that's a book where every single account, like cash, has its own spreadsheet. And this step 6 trial balance, I know exactly what this is, and I have my whole life. It's not hard, but I'll tell you, the name is very misfortunate. I told people in the podcast I wouldn't tell them why. It's misfortune and they can ask me, but in class here, I'll tell you real quick the history and why it was named this. When Kmart did have that big wall full of books, one wall full of journal books and one wall full of ledger books, because there was no computer, you might guess that when humans entered all that kind of stuff on papers, some of them would make mistakes. So when the company would be done with their year and they would go and list all those accounts down, whatever the general ledger said for a certain spreadsheet and whatever number it had, it just wrote the number down. They wrote the number down. It was almost certainly wrong. It was almost certainly wrong just because there were clerical errors and stuff in there, let alone, I mean, a clerical error is just somebody adds it up wrong. It might have been that somebody wrote the wrong accounts down. But anyway, the first time they took a look at this and listed all of this out on paper, it was a trial. So they called the thing a trial balance because they would refine it and refine it and refine it. So what you should really think of as a list of balances, a list of accounts and their balances. That's what we mean when we say trial balance. Now today, where everything is computerized, there are 3 trial balances that are important. The final one, the one that has all the final numbers, is one called an adjusted trial balance. So you'll be seeing about that in the class. And what you might want to call a final list of accounts with their balances, in accounting we call an adjusted trial balance. There are trial balances, but if they're not adjusted, then they don't have the year-end work in there, and they're not complete. The other one that you'll see a brief passing message to is the final one that's so final it's not complete. And that one's called a post-closing trial balance. So what happens then, this should make some sense to you philosophically. I'm going to say it this way because I think hearing it philosophically, when you see it, it'll make sense to you. With income accounts, income statement and expense accounts, if we want to count how good, or figure out how well a company did every year, we have to clear those out, right? If we're going to know how good 2021 was, we don't need the revenue from 1980 mixed in there. That'll just confuse things. We need to have just the revenue from January 1, 2021 to December 31st, 2021. Same with the expenses. So we have a formal process we call the closing process. And we remove the balances from all those accounts and we move them to retained earnings. like I was showing before the break. But when we do that, the post-closing trial balance might be right, but it's not the final accounting of everything, because it just blows right past income. It moves it all to retained earnings and doesn't worry about it. With this, we just remind you of some major account types. Assets are things the business has. Sometimes we call that stuff. They have stuff like cash, supplies, and equipment. Liabilities are things we owe to creditors. Here's some of the stuff you saw in the homework: accounts payable, salaries payable, utilities payable, taxes payable. Notice how many times we use the word payable there. It's not the only word we use for liabilities, but if something says payable after it, there's a good chance that's what it is. Because if you remember, liability meant we owe somebody. And if it says payable, that's a pretty good indication we owe them. Stockholders' equity accounts. You saw both of those titles in your work: common stock and retained earnings. Now, chart of accounts to me is a important document that we're going to deal more with. When I told you a slide or two ago about Kmart in the 1960s having this big wall full of general ledger accounts, just wall full of spreadsheets done on paper. Well, thank God these days spreadsheets are done on a computer instead, and you can, fit them all on a hard drive and have lots of room left over for other things. But somewhere we should have a list of accounts. Now, that's not the trial balance, which would be a list of accounts with their balances. Somewhere we should have a list of every account we want to use. We'll say later in the discussion that it's an accounting function. Somebody in accounting needs to sit back and figure out what accounts the business is going to use and which ones it doesn't need. New account, just regular accountants don't pick a new account whenever they're doing a journal entry. They have to look at the established list of accounts and choose one. So that idea of having a finite number, for Walmart, that's pretty big. For a small business, it's pretty small. But having a finite number of accounts, and you have to pick from that list. Imagine yourself, you're doing accounting on a computer. If you go type in an account that doesn't exist, you're going to get this error message that you can't process the transaction because you're trying to record something in an account that doesn't exist. The chart of accounts is the approved list of accounts. All right, now we're going to think about external transactions. So it seems to me that they're dwelling on the word external here. And I think it was like earlier in that example I showed you in the homework. They're really not getting it all that much here, but I think they might make you overthink. External just means they're dealing with other businesses. Whereas if it's internal, it just means, they might just be dealing with different departments in the same company. We said last time, and we're going to make a bigger deal this time, that every transaction has a dual effect. We called that double entry accounting. So let's get straight looking at these three things: assets, liabilities, and stockholders' equity. Let's get straight what dual effects would mean. If I buy for my company supplies and I use cash, the dual effect was cash went up and cash went down. That's a legitimate dual effect. That's precisely how you would record that. You'd have supplies, one asset going up, and cash, another asset going down. You could also have an asset like cash going up and a liability like notes payable going up because you borrowed money. You could also have this is a little bit more convoluted, and it's a convolution we're going to straighten out tonight, but just not right now. You could receive cash for work, and it would show an increase in assets and an increase in stockholders' equity. The big thing is you have the net effect on the accounting equation at the end, not the net effect period or anything. The net effect of the accounting equation has to be zero. For example, go back to the entry I said where company sold something. It doesn't go back to zeros if it never happened, but assets go up. If it's $1,000, assets go up 1,000. Stockholders' equity goes up 1,000. That's not a zero, but it does balance a certain way in the accounting equation. That's all we're getting at here is it has to have a dual effect. And that's all really the last 2 points here say. So this is a good thing. In what we have you do, a fair amount of it in the chapter 2 homework, when you do transactions, you know you're going to have at least 2 accounts. So you have to think about these first 2 things. What's one account that's affected by the transaction? Okay, what's another one? And when you get those 2, look at them together and think, do they bring the accounting equation back to zero? If we have debit cash and credit revenue, that brings the accounting equation back to zero. That's fine. If we have a reduction in cash and a reduction of supplies, that does not bring the accounting equation back to zero. Now the accounting equation is minus 2,000 if those were $1,000 each. And see how they wrote in red, the assets equals the liabilities plus the equity every time. That's what I mean when I say they're identical. They have to. It would be meaningless to show them not agreeing. And I find a lot of people just throw up their hands, which I understand. You know, there's sometimes I've looked at something long enough, I just throw up my hands and, you know, say, well, that's the best I can do. That's okay. You can do that, but you can't do that and say, well, it must be all right then. It's no big deal. If you leave a balance sheet that doesn't balance, or you do journal entries and they don't have the same effect on the accounting equation, bring it to zero, you didn't do it right. Okay, I'm going to skip this one in general. This is the kind of thing you have access to the journal entries here. I'm sorry, you have access to the PowerPoints is what I'm trying to say. You also might see this in your book with journal entries, but this illustration to me is just a list of all the transactions they're going to talk about. And now we're going to show you some accounting for those. And as we go on, since we have about 25 more minutes and 59 slides to go through, I won't be hitting all of these. I'll be hitting some. First one's always a good one to go through in some detail. So usually this is where I told you early in the night, it's a frustration to me sometimes with accounting books is that, yes, for every company, it started at the beginning. And usually that's when some people bought stock. But many, many people who study accounting never do these first transactions. So it's kind of a little, it's like, to me, it sends the wrong message. It sends a message that you're always going to be looking at this, and you're not, unless you are doing something for a new company. But here is a new company. So they sold stock for $25,000. One account affected is cash, because that's what they got. And then they asked the question, does it increase or decrease? It increased. The other thing when you're thinking and doing these things is, remember, we said this last time. So it's nothing we haven't said, but it's an important thing to remember and easy thing to forget. we're doing accounting for businesses. There's a separate entity assumption that says the owner is separate from a business. Also, believe it or not, there are accounting standards for personal financial statements. I have very rarely seen them done. And I've worked at an international accounting company. I mean, I worked for one of the largest firms in the world, and we did a few personal financial statements, but only a few there. And when I worked for smaller firms, I never saw one. So accounting is almost always done for businesses. And keep that in mind. You know, if you can't think, carrying this one step further, if you can't think about what business's perspective you're looking at, you're probably thinking about it wrong. Don't think about it from an individual standpoint. First question might be, until you're comfortable with this, what business am I doing accounting for? And then what does this mean to them? Let me give you an example of where this could be a trap. Suppose the way they worded this question is, Liam gave $25,000 to the business as a stock investment. Well, if it was worded that way, you might be confused about, are you doing accounting for Liam or are you doing an accounting for the Eagle Soccer Academy? If you can't answer that question, you have a good chance of getting it wrong. So the first question would be, who am I doing this for? And then you'd think through it, say, oh, I'm doing it for the Eagle Soccer Company. So I don't care that Liam is out $25,000. I'm not doing his accounting. What I care about is that Eagle Soccer Company got $25,000. Is there a second account affected? Yes. Common stock. Does that increase or decrease? It increases. Notice this is where I'm going next. I beat this kind of hard at first. We have a debit or a credit here, and one of them is not better than the other one. Let me point out something here that will happen once in a while. There is no law, no accounting law or otherwise a law that says you can only have one debit and one credit. So you can have one debit and 10 credits if the transaction calls for it. The rule is, and you've already heard it, so you're not hearing this rule new, I'm just repeating something you've already heard. The effect on the accounting equation has to be the same. In the end, if you have more than one debit or more than one credit, they have to equal in the end. But you're not limited to one of each. In the very beginning of foundations of accounting, we sort of act like that, but it's not the way it is. So for now, we didn't do a journal entry yet. I'm going to tell you, just to get you ready for it, that later on, we are going to debit cash because that's the way to make it go up. We're going to credit common stock because that's the way to make that go up. But for now, all we're doing is kind of warming you up for this, where you have this chart where both cash went up and stockholders' equity went up. A lot of words here. Feel free to go back and look at this as you want. I agree with the sentiment that they have. I don't know that I'd have chosen these words, but their point is, think about whether you're increasing or decreasing cash. You know, let's go back to that previous transaction. We're not doing accounting for Liam. We're doing accounting for Eagle Soccer Academy. What happened with their cash? We think about it. We say, okay, it went up. So if you debit it, that's right. If you credit it, you decrease it instead. And here, the authors are just trying to keep you out of logical pitfalls. Because we have a number of these, I'm going to kind of blow quickly through some of them, and some of them I'm going to stop and talk about in a little more detail. This one, the borrowed money from bank. And so what they want you to see here is the black stuff that you see written is either old stuff or a total, and the blue stuff is the new stuff. And the blue stuff needs to balance now before you ever put it in. And if you do your blue stuff right, the black stuff should always balance. Now they bought equipment. Notice our focus here that this is one of those transactions I told you about where all we have is assets. Equipment went up and cash went down. All right, so we have a little concept check here. That's a good place to stop and think about this. What would the effect on total assets? What would be the effect on total assets if the company purchased land for $200,000? The first thing for you to see is that both cash and land are assets. If you understand that, you should realize pretty quickly that the answer is going to be no effect. So what's the effect on total assets? Total assets goes up by 200,000. False. Why? Because land went up 200,000, but cash goes down 200,000. Total assets would go down by 200,000. False. Yes, cash went down 200,000, but land went up 200,000. There would be zero effect. True, because while cash goes down 200,000, land goes up 200,000. And let me warn you about something now. I know this is a concept question here, but let me warn you about something. When I started teaching, I taught at a very poor school. It's just, when I say poor, the school wasn't bad quality, but it catered to a very poor population. So I gave a test, and a student got a bad grade on it. And she came up to me and she said, "I don't know why I did so bad. I took this test taking class, and they told me that every time none of the above is one of the choices, or all the above is one of the choices, it's right 50% of the time. But I got way worse than a 50. So that, you might guess, that kind of bothered me. I mean, I didn't write my test that way, but the only time to me, and you could have connect work where all the above and none of the above's right, because that's on them, not me. But when you're thinking about the way I ask questions, really, if I ask an all the above or none of the above, I'm emphasizing something to you. Like, I might want to emphasize everything's an asset. So I might say, which of the following is assets? And I might want you to realize cash, land, and notes receivable are all assets. So the right answer might be none of all the above. But be careful with that answer for me. So here you see the answer to this question. As I said, the answer is zero effect. So I hope I've stressed this already as key point number one. The equation always has to remain in balance. All right, now, rent is a trouble spot, and it shouldn't be for you in an introductory accounting class. So if it does turn out to be a trouble spot, it's probably something we should talk about. But let me tell you how it happens. Notice this business of them paying rent in advance. Then look down at what they called that. It's true, but think about what they called it. They called that prepaid rent. Notice they said that's an asset. On the other hand, I don't know how you all pay for your like dorm rental, or if you have an apartment, how you pay for the rentals there. But ordinarily when you rent something, you don't pay in advance, you pay monthly, maybe first of month security deposit, first and last month's rent, with the last one being a security deposit. And very technically, you don't have prepaid rent then. You have rent expense. You paid for it as it was due. Let me not make a bigger deal about that than it is for now. I'm just saying, if you have problems with prepaid rent and rent expense, it's that issue. It's the issue of, was it paid in advance or is it paid monthly as you go? Now, let me warn you about the word credit. They didn't use the term credit here, but get ready for it. Notice that for the first time in these 5 transactions, the Eagle Soccer Academy bought something and didn't pay immediately. They bought supplies, but they bought them on account. That's a nice way to put that. I like it. But sometimes accountants use the term they bought it on credit. And here's what I have to warn you about the word credit. Credit has 3 common meanings in accounting class. So when you hear the word credit, you really have to stop first and think, which of the 3 meanings are we talking about? If this were phrased instead, purchased supplies on credit, they would mean on account. They would mean you purchased supplies before you bought them, before you paid. If I tell you to credit an account in a journal entry, or to write a journal entry and have a credit, that's another meaning. It doesn't mean on account. It means write it on the right side. Finally, we don't use this one that much in class, but it's something you hear in life. And if it came up in class, I guess the way I'm trying to get this out is, it just doesn't turn out to be a big thing in class. If it was, we would use this term and it would be confusing again. You all probably have thought in your own lives about your credit score. And that's like how somebody figures out whether or not you pay your bills and companies should loan money to you. So talking about your personal credit would be another use of the word credit. And you just have to really sit back and think about that word when you hear it. How are we using it? I guess the only thing I'll tell you after transaction 5, and then we'll keep going, is notice how after all these transactions, and now we have 7 accounts with balances, the accounting equation still stays in balance. It has to. In your podcast, I'll tell you that I don't quite say it this way, but I talk about this point, and I'll tell you something I don't quite get to in there. I have the 6th edition of the book. I showed you that last time, and I see there's an improvement in it over the 5th. I really think it's best if students have a page where they can see whether a debit or a credit makes every account go up or down. When you have that, that's sometimes called the rules of debit and credit. And I think I have something in the podcast about rules of debit and credit, because I was surprised it wasn't in the book. But this is as close as you get. Even when what I was talking about in the podcast, I said, if you look at illustration 2.3, it tells you why assets go up with debits. It tells you why liabilities go up with credits. It tells you why stockholders' equity goes up with credits. Now look at the little bracket thing going down from stockholders' equity. If stockholders' equity goes up with a credit and common stock is a part of stockholders' equity, that goes up with a credit. If stockholders' equity goes up with a credit and retained earnings is related to stockholders' equity, that also goes up with a credit. Then you come to the next line. The first one's easy. Well, no, I'm sorry. Let's see. Let me think about that for a minute. Yeah, the first one's easy. The next two aren't. So retained earnings. If one part of retained earnings is revenue and stockholders' equity and retained earnings go up with credits, revenue would go up with a credit. But then be very careful with expenses and dividends. Every single cotton picking expense you can think of makes stockholders' equity go down. So if stockholders' equity goes up with credits and you have expenses, every single expense will be debited to make the stockholders' equity go down. And the same is generally true of dividends. We talked earlier in last week's homework about how dividends reduce retained earnings. Well, if retained earnings go up with credits, every single cotton picking dividend is a debit. It reduces retained earnings. This, unfortunately, is not the rules of debit and credit. They're not in your book exactly, but it does show you the expanded accounting equation and why the rules of debit and credit apply. I think we've talked through this already. I do agree that the expanded accounting equation is important, and it's because it shows you these things, and they're all components of stockholders' equity. In transaction 6, we provide services for cash. We know time's getting low. Let me show you here that the biggest issue with providing training to customers is going to be whether it's cash or whether it's on account. So that's what you should be looking for. If it's on account, we're going to call it accounts receivable. As long as it's for cash like this one, we're going to call it an asset. Notice, there's what I'm talking about. This one's on account. So instead of cash going up, accounts receivable went up. And here's a prepayment. They called it deferred revenue. And this is right. Like when you have unearned revenue, sometimes I'll use the example of like sports tickets. You know, I know Shepard's team was really good this year. If you bought tickets, and I know students don't have to do that, but if you bought tickets to like all the home games, when you bought the ticket, Shepherd would have to record a cash debit, and then it would record an unearned or deferred revenue for all the credits, you know, and then as they played the games, they actually would do something called an adjusting entry, which we won't get to tonight, but we'll get to next class. Yeah, so I prefer the term unearned to the term deferred because I think the deferred term is confusing, but the point's not confusing. The point is that it's not revenue yet. It's a liability because in the case I gave you about the Shepherd football team, if you bought the tickets at the beginning of the season, they hadn't played any games yet. So they still had to do something for you. They either had to give you your money back or they had to play some games. Here they're paying salaries to employees. I don't know how difficult this is going to be for us this semester, but let me just point out that a lot of times this goes through salaries payable. And so it doesn't immediately show up in cash like this. So here's the summary. You can go back and look at it at your convenience. I hope in the few minutes we have that I hit a few journal entries. But if we've done all this stuff on our accounts right, then the accounting entry stays in balance like this. I'm going to skip this because I know we're down to just a few minutes. I like these concept checks sometimes, but I really want to hit a few journal entries if they're here. And see, they are coming up a little bit. So that's where I hope we spend the last few minutes. Learning objective 3, thinking about transactions resulting in debits or credits. So I may skip a little bit to see if that rules of debit and credit really show up in here that I was talking to you about. But this will show you how to make asset accounts go up or down, how to make liability accounts go up or down, how to make stockholders' equity accounts go up or down. Let me just see if there's an expanded rule of debit and credit here. Yeah, that's just what I wanted. When I was telling you before, this illustration 2.6 is what's in the new book. It wasn't in the old book that I could find, but I guess they do have the illustration here. And this shows you, my point, this does not get any easier than this. So it never gets easier than if you're trying to decide whether you should debit or credit an account. First, you've got to think, does this account go up or does it go down? Then you think, okay, if it goes up and it's a credit, I got to credit. If it goes up and it's a debit, I got to debit it. And you've got to think through that at least twice. And when you're done with that, you look back and see if it balances. If you have a debit and a credit and they balance, you're right. If you did this analysis and you thought you needed two debits or 2 credits, it's wrong. Okay. Use this if you want to. We talked about debit meaning the left side. All right, this is a picture of a journal entry, and we're going to talk about one of them, but we're going to be a real entry, not this, and that's where we're going to wind up. So here's a real entry. This is something that would really be done in accounting records. So we go back and we think through our transaction again. On December 1st, Eagle Soccer Academy sold shares of common stock to investors for cash of $25,000. So we analyze that and we think, we're not doing Liam's accounting, we're doing Eagle Soccer Academy's accounting. They received cash, so cash went up. They sold common stock. That went up. How do we show cash going up? This is the one time I'm going to take you back in the slideshow, a couple of slides, because this one's so important. How do we show cash going up? See there, we record it with a debit. How do we show common stock going up? Look in the second line, show it with a credit. So our entry is right then. Let's think about it. Let's think about why it's right, all the reasons it's right, and then that's where we'll end for the night. It's right because we were making cash go up and needed to, because Eagle Soccer Academy got cash. It's right because common stock went up. It's also right because we have a debit and a credit that balance each other. We have to have that. So this is where I'm going to sign off for the night. I got a couple minutes. I'm not signing off for any other reason than, I told you we took a break a little brief amount of time. We'd be done a little bit early. If anybody needs me for anything, I'll be on until we're all done. But I'm going to stop the discussion tonight. If there is anything I think was earth-shatteringly important and somehow didn't get into the podcast or